Hi friends, welcome back to the channel. In this video, I want to share with you 5 tips that I use to keep calm when the market is going through a bit of a downturn and the screens are red and everyone is panicking. Now, if you're new to the channel, my name is Charlie and I'm an investor based here in the UK. And on the Koala School channel, we're helping young and first-time investors to start their investing journey safely and successfully. Now, if you're like me, in a week like the week when I'm recording this, you see online, Twitter, TikTok, on the news, red screens everywhere and people panicking around a downturn in the stock market. People are worrying, does this mean something bigger? Should we be moving our money out of stocks and into something different like cash or bonds or crypto? And in this video, what I want to do is give you 5 techniques that I use to keep calm and focus on my long-term plan and to not do anything rash or panicky. So let's dive into it. The first of my tips or tricks is just to remember that things are not as bad as they seem. You know, if you watch the news online or on the newspapers, you'd be tempted to think that the world is a very dangerous place. Terrorist attacks, wars, burglary, you can see this and think that it's all around you and you should never go out of your front door. But the reality is there has never been a safer time to be alive. Life expectancy is much greater, infant mortality is much lower, medicine, technology, transport have made it a great place to be. But that does not make great news. What makes great news is war, disaster, terror, and that is what gets written about and recorded. And when you and I watch it, it can become very easy to think that is what the real world is like. And the stock market is exactly the same as that. When there's a small dip in the stock market or one specific vertical or industry is having a bit of a wobble, that doesn't make great news. What makes great news is tech stocks crash, stock market sell-off, Jenny from Twitter has lost all of her family life savings. These are the things that you read, and it can be tempting to think that that is exactly what is happening. But always remember to look beneath the story and realize that a journalist is trying to get clicks. And that leads me onto the second point, which is that if you have followed our advice and you've invested in index funds, then actually you are diversified across many different industries, many different countries, and definitely many different companies themselves. And that means that if a specific company or industry is having a little bit of a wobble, it doesn't matter. So whilst some of the technology companies and high growth stocks that people have been investing in have seen maybe a 20 or even 30% decline over the last 10 days, actually, when you look at the indexes like the S&P 500, whilst there has been a little bit of a drop back from the all-time highs early on in May, if you zoom out a bit, like here to 1 year, or even further back to 5 years, you can see that we really shouldn't be troubling our heart rate by having a massive panic here. We are still very near all-time highs, and there might be a little bit of a correction, but actually we can be a little bit more relaxed. And that brings me on to my third tip or trick, which is that if you have got a plan on the way up, then your plan still exists on the way down. So for me personally, my plan and strategy is around investing in a range of geographic index funds. So the S&P 500, which gives me some good exposure into the US market, which is obviously one of the biggest. But I've also got a couple of index funds focused on Europe and the Asia market as well. And for me personally, that's because I'm interested, yes, in growing money, but also in learning about different regions and different countries. And that helps me to get that exposure. Now that plan works as the market is going up, but that plan also works on the way down. Just because some US technology stocks are having a bit of a wobble doesn't suddenly mean that I should be selling those indexes or moving out of indexes into individual stocks or into bonds, for example. Now, if you didn't have a plan on the way up, and by that I mean maybe you followed a meme stock or saw something being pumped on TikTok or Twitter and you jumped on it because everyone else was jumping on it, well, you didn't have a plan. And then when that starts to collapse, what is your plan on the way down? Do you sell it because everyone else is selling it and you lose money? Do you hold on to it and hope that things return? You didn't have a plan on the way up, you don't have a plan on the way down, and that can be quite stressful. But if you did have a plan and a strategy, then you can just stick to that plan, even though there is a small rotation. Now, that brings me on to number 4, which is a long-term strategy. I am interested in long-term compounding growth of my investments over many decades, not weeks or days or months or even years. And therefore, I'm not interested in selling tomorrow or next week. Therefore, I'm not too worried about what the value of the index units or shares are going to be this week or next week. So it really doesn't matter. I'm interested in where they are in 20 or 30 years' time. The sell price is only important if you're trying to sell, and we're not trying to do that. Which brings me on to my 5th and final point, which is that as a young or first-time investor, you should be in buying mode. I'm in buying mode, age 44, and you should definitely be in buying mode. And in any other retail situation, when something is selling for 20% less than it was last week, we'd be smiling. A car is 20% cheaper, a holiday is 20% cheaper, some shoes are 20% cheaper. We'd be smiling and thinking that we've got a great deal. And it's exactly the same with your index funds. If you can buy them this week for 20% less than you could do the week before, then you should be thinking, I can now buy more for my money, and that is going to give me better long-term gains as I grow. So there we have it, the 5 things that make me feel calm while all around me are panicking over their red screens. The first thing, things are never as bad as they seem. Remember that journalists have got a story to write and clicks to get. The second is that if you invested in index funds, you're already diversified across a large number of companies, countries and regions and industries. So you're much better protected than those people that have invested in individual stocks. The third is that we have a plan. We had a plan on the way up, and the plan still exists on the way down. The fourth is that our plan is a long-term plan. We're thinking about many decades, and therefore we're not worried about what the price of our index fund units is today. And the final 5th point is that we're in buying mode. And therefore, if something is 20% less today than it was last week, we should be excited about that because we're going to get more for our money when we add to our investment portfolio. So I hope this has been a useful video, and if you've been stressing this week, what have I done? Should I be getting out of investments? Should I be getting out of the stock market? Actually, this will give you the confidence and the conviction to stick with your plan, and if anything, if you've got some spare cash lying around, to continue to invest it. Brian Ferraldi, who also runs a great channel and Twitter feed helping to promote financial wellness, has a great tweet where he talks about all of his great investment losses have got the same thing in common, and that is the word sell. I hope this video has been useful. If so, please share with your friends and click to subscribe to the channel. We've got a load of great new content coming over the coming weeks, and we look forward to continuing to help you, our young and first-time investors, as you continue on your investing journey. Thanks, and I'll see you there.